In 1968, researchers John Evans and Stephen Archer published a paper establishing the foundational rule of modern portfolio theory. They concluded that holding just 10 to 15 stocks perfectly eliminates 90% of unsystematic risk. In modern markets, this rule has become mathematically obsolete. This classic diversification curve shows portfolio variance dropping rapidly and flattening out at 15 stocks. But modern empirical data proves this is inaccurate. The line continues outward, refusing to flatten until the portfolio count has more than tripled. This creates a false sense of security for anyone still following the old rule of thumb, leaving their capital exposed to the very risks they believe they've eliminated. The first major flaw in the textbook model is its over-reliance on standard deviation, daily volatility as the ultimate measure of risk. Standard deviation has a massive blind spot over multi-decade horizons. Because it treats all upside and downside deviations equally, it averages out extreme losses and masks the true probability of long-term failure. The superior metric for long-term investors is terminal wealth dispersion. This scatter plot maps 15-year return distributions for simulated 10-stock portfolios. Notice the wide range of final outcomes from massive gains to devastating shortfalls. Now look at the simulations for a 50-stock portfolio. The data points cluster tightly together, converging safely around the mean. This illustrates expected shortfall, the expected value of losses in a worst-case scenario. That calculation dictates capital survival far more than day-to-day maggot bumps. Measuring risks strictly through daily variance is structurally flawed. True risk is the statistical probability of reaching the end of a 20-year horizon with drastically less money than you need. To understand why those shortfalls occur, we have to closely examine idiosyncratic risk, the danger of isolated corporate blow-ups. Take the Indian Energy Exchange, or IEX, as a prime example of an abrupt regulatory shock. When the Central Electricity Regulatory Commission proposed new market coupling norms, the policy shift instantly destroyed value, crashing IEX shares by 7.5% in a single trading session. This pie chart illustrates a 10-stock portfolio. When one position drops 7.5%, it gouges nearly a full percent out of the total value. Inside an optimized 50-stock portfolio, the damage is diluted across 50 thin slices. The shock is absorbed, registering as a minimal 0.15% loss. Individual stocks can and will blow up due to fraud, bankruptcy, or regulatory shifts, regardless of how well they performed in the past. A small portfolio amplifies these idiosyncratic failures, turning a single bad headline into permanent capital impairment. The macroeconomic forces that have altered the requirements for diversification are driven by a two-decade shift in market correlations. This network graph represents the equity market in the year 2000. Stocks traded on their own merits, moving independently 65% of the time. Fast forward to today's integrated global market. Equities now move in unison, positively correlated roughly 65% of the time. The mathematical consequence of this shift is that when assets are highly correlated, systematic drag increases. To offset that drag and locate true non-correlated returns, the total number of assets in a portfolio must be drastically increased. You can no longer rely on 15 random stocks to balance each other out when the entire global market moves as a single correlated organism. The ultimate stress test for any portfolio occurs during periods of high volatility and black swan crises, like the global financial crisis or COVID-19. During these shocks, human and institutional panic takes hold of the market. This introduces tail fatness and jump risk. When panic sets in, correlations aggressively spike toward 1.0. everything sells off at once. This chart of the rapid market collapse in early 2020 demonstrates that reality. The sheer vertical cliff drop centering on March 16 is undeniable proof of global correlation locking together. The classic 15-stock portfolio fails completely in these moments, breaking down precisely when downside protection is needed most. There is an exception in emerging markets, which require fewer stocks for optimal diversification. Because they are less integrated with global indices, they maintain lower correlations. Diversification is a shield that melts in the fire of a crisis, unless it is heavily reinforced by distinct geographic separation or a massive increase in asset count. This prompts a professional counterargument. Can an active investor still survive and beat the market, holding only 20 stocks? We are all familiar with the popular mythology of conviction picking championed by legendary billionaires. But running a 20-stock portfolio today only works mathematically if you completely abandon the standard naive strategy of equal weighting your assets. You must introduce complex quantitative solutions, specifically minimum variance optimization or hierarchical risk parity. These algorithmic clustering methods bypass human bias entirely, solving for the mathematical errors inherent in traditional inverse covariance matrix calculations. Implementing this requires intense active management and robust computing power. For the average investor, the simple passive reality is just buying 50 stocks. A small portfolio lacking these algorithmic guardrails remains structurally vulnerable to the specific corporate failures that a larger, simpler portfolio would neutralize. Summarizing the latest academic consensus gives us a clear, actionable three-tier architecture for modern equity allocation. The active optimized portfolio strictly limits holdings to 20 or 30 stocks using machine learning. The active naive portfolio requires 40 to 50 stocks for an equal weight strategy. The foundational hybrid model uses broad ETFs to neutralize tail risk while allowing conviction picks. Modern diversification requires a structural engineering approach, one that accounts for global correlations.